Hey everybody, welcome to another episode of Blockchain Central. In this video, we'll take a closer look at crypto exchanges. Crypto exchanges serve as a trading platform for cryptocurrencies like Bitcoin or Ethereum. In total, there are more than 1,600 cryptocurrencies in circulation today, with a combined market cap of over $256 billion US. Investors from all around the world are actively trading these rapidly growing cryptocurrencies through a variety of different types of crypto exchanges. The exchange allows investors to buy, sell, and trade cryptocurrencies by exchanging them into fiat currencies like euro, dollar, or yen, or other cryptocurrencies like Bitcoin or Ether. Smaller, less popular cryptocurrencies called altcoins can often be traded against Bitcoin or Ether. This means if you want to buy a less popular cryptocurrency, you might have to exchange your euros, dollars, or yen to Bitcoin first, then swap your Bitcoin for the desired altcoin. It is important to know that not every crypto exchange supports every cryptocurrency, and many investors therefore use multiple platforms to trade cryptocurrencies. Apart from the currencies they offer, crypto exchanges also differ in their target groups. While some exchanges are better suited to less experienced traders and retail investors, some are geared towards institutions or full-time traders. There are two main types of crypto exchanges: centralized and decentralized exchanges. Centralized exchanges are run by profit-oriented companies that get revenue from their platform's fee structures. Although these platforms call themselves exchanges, it is important to know that they function similarly to e-brokerages, and the rapid rise they are experiencing at the moment is similar to the boom of electronic discount brokerage firms during the dot-com bubble of the late 1990s. Based on the location of the centralized exchange and the type of services offered, the law governing these exchanges vary. Some are currently not regulated at all, and some are only available to investors from certain countries. But all centralized exchanges are vulnerable to a rapidly changing regulatory environment. For example, after China cracked down on cryptocurrencies in November of 2017, all Chinese crypto exchanges were forced to shut down completely or move their operations outside of China. Other crypto exchanges recently had to suspend Japanese investors from using their services following new guidelines issued by the Japanese Financial Service Agency. In the US, exchanges are subject to state-by-state regulations as well as federal guidelines. The state of New York, for example, implemented BitLicense regulations that require virtual currency businesses to have a state-issued license as early as in 2015. Decentralized exchanges, on the other hand, do not rely on the third-party service to hold the customer's funds. Instead, trades occur directly between users through an automated process. Because of the lack of a third party, one can only trade crypto to crypto and not to a fiat currency like euro or US dollar. Due to the fact that decentralized exchanges are not being restricted to one physical location, decentralized cryptocurrency exchanges are much harder to regulate or shut down compared to the centralized ones. As a result, many choose to keep their founders' identities anonymous. For small decentralized exchanges, this can raise some red flags and can be evidence of a cryptocurrency scam. The main problem with decentralized exchanges is that they are slow, do not have friendly interface, and often lack traffic due to lower user numbers. Therefore, decentralized exchanges should be used by experienced crypto traders due to their anonymity and potential risk. People who are completely new to crypto exchanges should check out a more mainstream centralized service and get to know the system before dipping their toes into the decentralized exchanges. Even though the variety of exchanges and their options and offerings can be overwhelming, the space stays hyper-competitive as each platform offers a different fee structure, trading features, coins on offer, and security and insurance measures. Most exchanges, however, charge trading fees based on a maker-taker model, which offer a transaction rebate for those who provide liquidity, the market maker, while charging customers who take that liquidity around 0.1% or 0.2%. The main aim of maker-taker fees is to stimulate trading activity with an exchange by extending the incentive to post-order and, in theory, facilitating trading. To date, there are more than 200 cryptocurrency exchanges that support active trading, and the combined 24-hour trade volume of the top 10 is more than 5 billion. The top 10 alone are generating as much as 3 million in fees a day, heading for more than 1 billion per year, according to estimates compiled by Bloomberg. While these projections are rough estimates based on daily trading volume and fees listed, annual revenues for the top 10 platforms go into billions of dollars. While the numbers aren't exact, the sheer magnitude shows that the boom in digital currencies is generating some very real cash. Maybe the most important difference between the cryptocurrency exchanges are their compliance frameworks. Okay, so what have we learned in this video? First of all, you now know there are a variety of cryptocurrencies that you can trade on different centralized and decentralized platforms based on your personal needs and preferences. Secondly, if you want to trade altcoins, you might have to buy Bitcoin first and then trade Bitcoin for the desired altcoin. Third, if you want to trade on centralized exchanges, it matters where you are from. Make sure to check the regulations of the country and state you live in, as well as the regulations of the country and the crypto exchange operates in. And last but not least, make sure to read the fine print for each exchange before you register to trade. That's it for this episode of Blockchain Central. Before you go, please note that this video does neither represent financial, legal, or tax advice, nor is it supposed to be understood or interpreted as solicitation to buy or sell any securities, coins, or tokens. Thank you for watching, and if you like this video, make sure to hit the like button. Don't forget to subscribe to Blockchain Central to never miss a beat. Happy investing.